right, here we go. Pull that up and pull this up. Okay, so we're back to building a portfolio again. And we had, we talked about these ETFs, like XLK, right? Or, QQQ is another one, right? These ETFs. And, they have these other ETFs, like this TQQ, right? This is a leveraged ETF. And so this is the TQQ, and it seeks daily investment results, right? And it has fees and expenses. And people will get really, really, really worked up about these fees and expenses. They'll say that these fees and expenses are eating up all your profits. And how this works is it leverages, it 3x daily performance of the NASDAQ 100, right? And you come and you can read this stuff, and it says it's a daily investment results, right? And that means it gets rebalanced daily, right? And the fee actually comes off of the rebalance, the daily rebalance. So you don't, it's not like you just pay a fee once a year of 1%, right? Like you don't even notice it because it just comes right off of the price action of the stock, right? So it's not even something that you need to pay attention to, right? Because it's baked into the price of the stock every single day. So you don't even see it. It's not like you just get a hidden bill, sent in the mail that says, hey, you owe us, 1%. It doesn't work like that. Right? And it says for any holding period other than a day, your return may be higher or lower than the daily target. Right? And these differences may be significant, right? And that's true because what this does is it amplifies your return, positive or negative, by 300%, right? So if the NASDAQ 100 is going down 1%, you lost 3%. If it goes down 10%, you lost 30%. But if it goes up 10%, yours goes up 30%. Right? And people will get in on these and they'll write a whole PhD thesis on volatility decay on these things. And it's funny because they never, it's all this apocalyptic stuff, right? They talk about the volatility decay, but they don't tell you about the compounding growth that these ETFs deliver, right? So, maybe you want to, leverage, technology. So they have this, TECL, 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 right? And you're going to put that at 20%, right? And maybe you are going to, maybe you want semiconductors, right? So you have semiconductors, but you say, you know what? I want to leverage semiconductor stock, right? Okay, go outside. And you can get semiconductors, right? You got it? You need help? I'll help you. Alright, your hand. There you go. Okay, so, maybe you want to leverage semiconductors. Now, a lot of people, they think this is blasphemous, right? I mean, They think this is the riskiest thing you can do is get into these leveraged ETFs. They think that they're going to, bottom out and rip all your money and bleed you money. I mean, they say they just bleed money. I mean, this stuff is nonsense, right? Maybe you want to, you know, maybe you want to get into, maybe you want to leverage, you know, the SPY, right? Maybe you say, you know what, I'm gonna leverage that, right? So you go to, you know, SPXL, right? You say I'm gonna leverage the SPY, right? And maybe maybe there's a maybe you say, you know what, I'm gonna actually get into an actual company like Nvidia, right? Maybe you hear about Nvidia and you say, I wanna be a part of that, right? Well, let's not even use Nvidia because Nvidia is an outlier. Let's go with AMD. Everybody, they call this advanced money destroyer, right? like, like that's the people in the AMD community. They call it advanced money destroyer. I mean, it's crazy. And then let's say you wanted to get into computer infrastructure, right? Now remember that you have two actual companies here. You have Super Microcomputer, which is they're basically building the racks and the infrastructure to hold these semiconductors and these these supercomputers with. You have AMD that's building the semiconductors. And then and then you went with ETFs and you decided to leverage these ETFs because you want the same results that you would get with individual companies, right? But without picking individual companies, okay? But maybe you decided to pick a couple individual companies, and these are the ones that you came. Maybe these are the ones you came to the conclusion to pick, right? And you're going to go with $200 a month, and because we'll see what happens, right? Let's see what happens, right? So you throw these leveraged, ETFs in there, and you look, right? And look at that, right? You're looking at $218,000 versus the VU investor at $49,000. I mean, you 4x the return of the Vanguard investor, right? And maybe they'll just say, well, you got lucky, right? They'll make up whatever they can to or you took too much risk, and they'll come down here and they'll say, your drawdown was, I mean, you lost 50% more of your money at one point. While they only lost 17% of their money at one point, right? So you had mega drawdown, right? And this is what they scare people with, are these drawdowns. So you come down, and you want to look at the drawdown. So this graph here tells you a lot, right? And this logarithmic scale this is really how you really want to look at how stocks behave, because it's showing you the percentage growth over time, right? What's the percentage change, right? Versus this is a linear growth, right? And if you can see the difference, right? I mean, there's you can see the magnification going on here with this stuff, right? And this is the when it's magnified like this, right? This is how you see stuff, right? So you come back here to 2018, and you're looking at it, and you have $18,000, and you've more than doubled a Vanguard investor, but you're on the downtrend, right? I mean, you lost $6,000. You gained a little bit and then you lost it again. So you went from 18,000 to $11,000. You know, I mean, you've nearly lost as much as the Vanguard investor has, right? And that's what they're getting at is like you have these big drawdowns, right? But they're not comparing, I mean, even with the drawdown, you're still outperforming the Vanguard investor. So the drawdowns, they don't matter. Like people want to get into it like, oh, well, you lost all this money and whatnot, but that's I mean, you can't predict the market, right? You don't know what's going to happen. And the longer you're in the market, the more amplified it's going to be. So look at this. A couple years later, you're at 32.7 thousand versus 14,000 in Vanguard, right? And I mean, you're severely outperforming, and then you go red, right? You lose. Look at that. You go from 34 or 33 down to 20, right? So you mean you lost more than Vanguard had even made, right? But it gets even worse the more you get, right? So it just amplifies way up, right, to 2021 where you had $102,000, and the Vanguard investor had 28,000, but you hit a bear market, right? You hit a bear market, and for that year you went all the way down to $50,000, right? So you lost more than double what Vanguard investors had even made. And that's what they scare you with, right? Like that's the fear, that's the risk that they're talking about, right? Is they put this risk in there, right? To scare people, right? And of course, the longer you are in the market, right? Like, see, you hit your peak was 102. Now, imagine